The views expressed in this video presentation are my opinions and not necessarily the opinions of guests and others sharing or reposting the video. The content is produced for educational and informational purposes. Do not regard any statements in this video as a recommendation to buy or sell any investable instrument discussed. Investing comes with risk to loss of principal. Always conduct your own research and seek guidance from a professional investment advisor. I am not a professional investment advisor. I'm Dollar Will. Let's make some money. I have to tell you, sadly, the bear is back. This little run-up we've experienced in the market since the downturn, I think is over. I'm calling it. Based on a pattern I see in many charts. Let's see, let me put this line, put a little trend line here. And that pattern is a bearish engulfing candlestick. Let's see, what is a bearish engulfing candlestick? A bearish engulfing candlestick is, see the fat part of the candlestick here, this green. You have the wicks. You have the a little stem sticking out the top, usually like on this one, and the stem sticking out the bottom. The stem sticking out the top and the bottom, that represents the high and the low. The bottom part is either the body is either the open or the close, depending on the direction it was moving. You won't know until you look over in the box, eyes left, upper left corner. It'll tell you what the closing price is. In this particular example, in an uptrend, like a green candlestick, the close is likely going to be at the top. Let's see. So we got the high is at 27.80. And so the close would be 27.79, and you'll see the open was at 27.57. So yeah, that makes sense. In an uptrend, you usually close near the top. Now in a downtrend, you close at the bottom. So in this case, we're going to be comparing the close of the candlestick on the 26th. And that would be Monday. The close on Monday with the open yesterday, the 27th. So the close on Monday was 27.79.60. The open on Tuesday, the 27th, was 27.80. So the point I'm trying to communicate is the open was higher than the close. We're not really looking at, we're going to go textbook on the definition of engulfing candlestick. Okay, and so the textbook definition is if the next day opens higher but closes lower, meaning that the entire bearish day fully engulfs the body of the positive day before. That's an example and a definition of a bearish engulfing candlestick. And there's also the opposite called the bullish engulfing candlestick. So this is one of the patterns that a lot of people who, I don't get it too much into a whole lot of candlestick patterns other than head and shoulders and reverse head and shoulders and these engulfing candlesticks. The reason why I like to keep it to these because these are the most reliable of the reversal candlestick patterns, and I find that it's pretty reliable. Not guaranteed, but pretty reliable. Now, combined with violation of this support trend line and we're in a over on my stochastic down here. We're in the daily chart, stochastic. We're in the overbought state. Now we don't have a crossover yet. A crossover would be when the fast line, in this case the black line, crosses over this orange or whatever that color is. But I'm calling it. For me, this is good enough. But you keep your eye on it. If I was making a trade, I would act right now. I would keep an eye on it, but it's going to take a lot to reverse that candlestick. But we'll see. So that is the S&P 500. What I'm going to do is just move along to all the majors, the S&P, the Dow, and the come on, the Qs, the Nasdaq. Okay. What we have here is a reverse of the S&P. It's a bear market ETF. It's a ETF that basically it shorts. It's a way to short the market. And what do you see here? You see the engulfing, bullish engulfing pattern, a candlestick, and you see the trend line violation, and you see us oversold. I believe we go higher. I would act on this. That's a buy for me. Now, warning about all of these ETFs. Now, these are the explosive triple leveraged ETFs that I'm pointing out. You really have to watch them because they don't always do what they should. I find as the trend goes on and people abandon their long position as opposed to buying put options as protection, sometimes these ETFs don't continue to rise, say in this case, as the market falls. So you kind of have to watch it. But other than getting out of the market altogether, um, in terms of the most explosive way to make money, this is it. This is it. But it is dangerous. It's not the kind of thing you should set that you like. It's not set and forget. You have to watch it, and you have to be ready to get out. You know, so you definitely want to use your Fibonacci extensions and trend lines and trailing stops and all that good stuff with these ETFs because they are not uh, predictable in that way. So this is not for you to put the lion's share of your money in because it is risky. Now later this week I will be showing you some other industries. There are a few other industries that are starting to turn around where you don't have to short anything. You'll be able to just traditionally invest in a long on the long side, but you're not going to get the explosive kinds of returns that we're talking about here. Let me see how. I'll show you something. All right. The back of 2009, look at eyes to the upper right. The high of this particular short fund was 1,720. Now, will it go all the way back up there? Or will it do something strange instead? I do not know. But for me, I'm going to see. I'm going to see. Talk to your investment advisor for advice on this high risk bear ETF. I'm just showing you the options, and you'll have to do your own research and assess your risk tolerance. Of course, I'm using the stock barchart.com. I like this site. It has a lot of screens, pre-screened information, so I can quickly find out where the money is moving and what symbols I need to invest in. Okay. In terms of explosive ETFs or risky, volatile, this is it. Now, this VIX, um, this is a double leverage VIX, meaning as the S&P 500 goes down, this goes up. Now, what we got right here? We got way back in 2010, eyes to the upper right. This will blow your mind. This is hard. It's hard to even for my mind to reconcile what I'm looking at. Okay, on this scale, the high was 28,087,500. Okay, that's hard. That's hard to even imagine. We're talking cryptocurrency kind of gain. Okay, you don't have anything cryptos to compare to this. Cryptos can't touch this. I'm not saying don't do cryptos. I'm just saying it's not the only game in town. So same symbol, just looking at it in the daily chart. So the low here, eyes upper left, the low was $4.66. Okay, it came down, and what do we see here? We see that it's not quite an engulfing candlestick, but it's a huge candlestick, and we did make a higher high. It doesn't engulf it, but it's a higher high, and it's good enough for me. Make up your own mind. Let me see. Let me get the trend line here. Yep, that's good enough for me. Let me take a look at the stochastic, see what that looks like. Now, you usually, if ever you have a choice between fast stochastic and slow, pick the slow. Anything below 20 is oversold. I'd buy it. I'd jump in here. I wouldn't mess around. At the open tomorrow, that's what I jump on this. I wouldn't even wait around. I wouldn't overthink it in terms of entry price because this thing could move pretty fast. You want to get in, or if you're thinking about it, if your advisor tells you that you should get in, don't mess around. Now, here's the thing that concerns me about something with a high of 28 million. At some point, this thing is going to become, let's say, $100 a share. Now that price might spook some people. Okay, one day you're going to look up, it's going to be $1,000 a share, and you won't be able to get in. So I say that the time for the average, the commoner, the working class person, to make a Vegas bet on a very small amount that they can afford to lose. This isn't rolling your retirement into it. Some beer money into this. The time to do it would be when the price is only, what are we, $15. That's the time. The time is like now, because you can, at that price per share, you can do it, but very fast. This thing is going to get to be $500 or $1,000 for one share, and that's going to price the common person out. And I don't think they're going to do a reverse stock split. That's where they adjust the shares to make the price affordable. I don't think they're going to do it. I think that the once the price gets to be $1,000, they know that only institutional investors and basically very rich people will be buying this. So the time for working class folks to get it is while it's affordable. If you only have $100 to invest in this or $200, I think in pretty record time the price is going to jump to be more than $100 or $200. So don't let this get away from you. Keep your eye on it. Just passing along the information. Okay. I'm not going to spend a lot of time talking about the Dow. This here is the Dow. I'm not going to spend a lot of time because it's the same story as the S&P. Not much to say other than one, it has not yet broken the trend line, but we do have a bearish engulfing candlestick. I checked it. It just hasn't broken the trend line, and we are overbought. So I believe we go lower. We'll see. We'll know today in today's market. You're probably watching this video while the market is on in session, and keep your eye on it. Yeah, I think we go lower. Okay. And I don't even have to be so convincing that we have make much of an argument that we have a bearish engulfing candlestick right there. Okay, we just haven't broken the trend line, and this here is the Nasdaq. This is the Nasdaq. So all of your tech stocks are here. So the Dow and the S&P have a lot of industrials in it. The Nasdaq has a lot of course, tech stocks in it, and there are a few tech stocks that are also in the Nasdaq and the S&P 500. The point I'm trying to make here is in all three major indexes, they all have a bearish engulfing candlestick, and they all move close together. Okay, so people think that they can diversify by putting a little in the S&P and a little in the Nasdaq, and they think that they're safe. You're not. They all are correlated together. They all go up and down pretty much together. Not exact, but essentially. Okay, and they're all falling uh, now. I believe we'll see tomorrow. I believe that trend line is gone. It's just going to be broken at the open before the market even opens. I think it's already going to be falling. We'll see. All right. If you are getting anything out of this information, if you think you can make money off of this information or have some good talking points to discuss with your financial advisor, please subscribe to this video and pass it to someone you know that needs this information. Okay. Last but not least, here is one that I recommend. That I don't want to say that word recommend. No, I'm not recommending anything. This is one that I like. This is a small cap bear fund, and it is what it says it is. It's a bear. It's a bear. It goes up as the small caps come down, and these are your smaller companies that have risen, um, and you're capitalizing off of the decline of these smaller companies. The smaller companies generally rise higher because they're so small. Their market share is so small. They have a lot of room to grow in the market, and they generally cost less per share. So explosive growth rate and low share price, usually and higher growth rates, all that stuff that fundamental analysis traders like to look for. The small caps provide them a lot of good area to grow, but it comes with added risk because these small companies generally don't have the capital to grow. So they are not as safe as, say, the bigger companies. Now, in a bad environment or slowing economy or major technical correction, the small caps get crushed because they don't have the money to survive tough times. Selling stock is one way companies make money. If the market is in a downturn, they can't make money by selling stock. This is the time period where bigger companies come and buy them up. But it doesn't necessarily mean, when you're in a bear market, it doesn't mean that the price will go up because of an acquisition. So don't play that game. But the smaller companies are more susceptible to uh, decline faster and farther than bigger companies. So in order to profit from that, this symbol TZA, is a good way to do it. I'm gonna show you the high. I don't. It's not a ridiculous $1 million high. I'm gonna see where it is. It's good enough. 37,579.20, and the price right now is $10. Now, at some point, it's going to be $1,000. Will you still want to buy it? Probably not. I'm looking at a quarterly chart right here. So for you volume watchers, looking at this red, just remember it's a quarterly chart. Let me put it on I'll try a weekly. So you haven't overtaken the candlestick there. Let me give you a daily. You guys know volume. I watch volume after the fact. It's nice to look at after the fact. But I've usually already made my purchase before the volumes. Now for you volume watchers, I guess this would be a buy for you, that you have a big green candlestick that was bigger than the previous day or 2 days. Well, the trend line and the engulfing candlestick is my buy signal, and it usually corresponds with increasing volume. So that's kind of why I got out of looking at volume, because by the time I get my engulfing candlestick, like I said, most of the time the volume it corresponds with it. Well, that's all I have. Like the video, comment, and subscribe. Like I said, pass it on. And stay tuned for another video about housing, for people who are wondering, how is this market going to affect real estate.